All right, here we go. We're going to talk a little bit about stocks and bonds. This is week 9 here, investing in stocks. So, like I say, when you're investing in stocks, potentially, well, you are buying a small part of a company, corporation, to be more specific. It actually represents an equity position, an ownership position. So, if you lose money in the stock market, yeah, it's not like a loan or something. There is no recourse. If the company goes out of business, that was your company. You owned a part of it. And so that's why you have to choose things pretty wisely. Now, the good news on stocks and the market in general is that it goes up roughly about 10% per year. And that's been true for, 100 years or so since the turn of the century. There's been dips, major dips. The Great Depression and then whatever they call the thing back in 2007, 2008 where it dipped again. But again, in the long term, things go up. What you have to fight against is, inflation and the debasement part of the economy. So if just putting your money in the bank was good enough, you'd probably do that because it represents no risk. But just the way things are, you're driven to seek higher yield. Now you don't want to do it irresponsibly, but you know taking no risk at all is a big risk. Just inflation just drags things down. We'll talk more about inflation as we go. But anyway, so to buy stock, it used to be a super difficult process, and it's just things have gotten so much better. We talked last time about the different categories between institutional and retail, and it used to be like 20 years ago where they kind of let retail guys kind of dabble in it, but you had to have an intermediary, a broker, and these brokers were, number one, they were charging a commission, and number two, they often weren't giving you advice. Even right now, I've got a friend he said he was talking to his broker, and his broker's got to go get some training. Well, is the broker getting training on stocks, on financial analysis? No, the broker's a salesman. He's getting, techniques on sales. They do have people who analyze stocks, but often they're analyzing stocks and then they don't fully disclose that they've got a position with that company. Now, per the SEC, the Security Exchange Commissions, that is not supposed to happen, but I'm telling you, back when I used to use a broker, back before there was automation in the internet and online trading, I, more often than not, would have a stock that would go down significantly, and then I'd get a letter in the mail about a class action lawsuit because that company, that brokerage, some of these that don't even exist anymore, they had a position in that stock and they were getting paid basically to press it upon their clients. And so they didn't execute what should have been a fiduciary responsibility relationship where they're looking out for my best interest. No, they were trying to push stock that they had an interest in. So, yeah, the whole thing of corruption and all that is rife within the financial world, and plenty of movies on that. We'll talk a little bit about some of the movies that are actually pretty good, pretty illustrative of the whole thing. The Big Short comes to mind. If you've seen that, very well done. And yeah, all that stuff still sort of exists today. So anyway, where do you buy stocks? Not so important. The physical address, it's not like you're going to go to New York or wherever to do this. You're going to select a brokerage. They've got a representation there, and they will execute the trades for you. So, yeah, but most of them are done through the New York Stock Exchange. Although New York is losing a little bit of its financial dominance. Places like Miami and stuff like that are actually starting to ascend a little bit. We'll see what happens, but things are changing a bit. But most trades now are even on the New York Stock Exchange. I'll make trades and they're executed within seconds. It's not some guy on the floor yelling out orders. No, it's done electronically. In fact, what the new thing is, is the actual space, even though electricity goes at the speed of light, it does make a difference in terms of the distance between when orders are submitted. So brokerages still want to be centrally located, because it's not even milliseconds, it's less than that delay in the orders does affect things. And so we'll talk more about that. That's kind of high tech stuff, but it is interesting that they still want to be very closely placed together for those even electronic delays. Specialist traders, there's a lot of other things going on in the markets. They have what they call market makers, people who they keep kind of a big picture on the market, and they're specialist firms and companies that actually perform a function, but they seek to keep the market level, because the market, it's supposed to be free and all the rest of that, but there is some meddling between now and then. The New York Stock Exchange isn't the only one. There's still Amex, and then some regional ones, and then there's international exchanges, but it's really transparent to you. Do I care whether it's traded on the New York Stock Exchange or whether it's done through something like NASDAQ, which is just sort of a virtual exchange? Especially since, most tech stocks start on NASDAQ. The New York Stock Exchange has actually lost some of its glamour, some of its dominance, because some of the other exchanges, people have made more money on them just because they deal with smaller, maybe perhaps more volatile companies. To be listed on the New York Stock Exchange, you have to be a fairly substantial corporation, and which is fine. Maybe, more established, but maybe not as dynamic in terms of rapid growth. So, over the counter, this is the electronic type things, and NASDAQ is one of the primary. NASDAQ just stands for the Association of Securities Dealers, the people who actually organize it, but less stringent listing requirements than for New York Stock Exchange. Now, even below this, you've got stocks that are traded not on the exchanges, and those are what they call penny stocks typically, because they're typically denominated less than $1. And this is the Wild West. This is just not regulated by the Securities Exchange Commission, just crazy pump and dump schemes, all kinds of scary stuff can happen here. And it's, typically pitched as a get-rich-quick scheme, and more often than not, just doesn't work out. For that, if you get into the Wolf of Wall Street, that's kind of where he made all his money, or actually took money from people. He made a ton of money, but the investors, not so much. To even say they're investors is kind of a joke. They're more of just speculators. So the Electronic Communications Network matches them up. After-hours trading is kind of dangerous. Now, on things like crypto, that's done just as a matter of course. Crypto exchanges don't close. Crypto is actually kind of cool, because it's back in the old school days where there's not as much regulation, and you can, if you want to lose a fortune in a heartbeat, there's no training wheels. If you want to do that, you can go international, you can register, and you can get clobbered. Probably, it's a younger market in terms of not only the participants, but the regulation. But anyway, so after hours, the problem with after hours trading in stocks is that sometimes there's very little volume, so you can have huge price swings. So I even trading around, near the holidays. Now, obviously, they're going to be closed on Christmas, but you may see some price volatility around the holidays because a lot of people aren't there. And so let's say you're trying to sell whatever. You're trying to sell some NVIDIA stock for, 185 or something. And it's going to, if you put it in there as a market order, if there's nobody at 185, well, maybe there's somebody at 180, or maybe there's somebody at 175. And next thing you know, you took an order for 170 just because not as many people were in the market. So a couple things about that is NVIDIA is probably not the best example choice for me because there is a huge amount of interest in NVIDIA. So even in an off time, if you could trade after hours, you probably wouldn't see those big fluctuations. But anyway, so just because you can trade after hours doesn't always mean it's wise. You want to look at the volume to make sure it supports it. Price quotations. This used to be this arduous process. You'd go to look in the classifieds. I mean, I was in the Middle East back. This was Desert Storm time frame. We're talking 91. We're talking a long time ago. And I was fairly actively trading stocks, and I had to have a freaking broker. He's the guy who basically bit me off on a few times. So I learned a lot of who not to deal with, but also trying to get stock quotes, going to these big hotels and, these Middle Eastern capitals, Riyadh and down in Bahrain, and trying to get the New York Times to see what the quotes were, and they're already a week old. It's hopeless. Now everything's done online, instantaneous, level playing field, much, much better. It used to be that all quotes were delayed, and that's why people had Bloomberg terminals, which was a real-time quote display. Now you can pretty much get that online and real-time, near real-time. So pretty cool. This is the other thing. So this is how it used to be presented. This is what you get, and you're supposed to make decisions. A high and a low for this is over a 1-year period. Stock with they actually paid a dividend here, yield, price to earnings ratio. But this is all just tabular data. The volume 9,000, is that a lot? Actually, it's multiplied by 100, so whatever, 90,000. Close of that day was 50, and it was up 27. When you're just presented so little information, you're not seeing a trend, it's really difficult. So what we have now is charting. Super, super useful. So, now here's that price. Here's NVIDIA. NVIDIA is the big microchip. I've had these guys. I bought this stuff. This price actually represents a stock split. They went 10 to 1. So this price, backed on what I bought it for, I wish I had kept all of it. I kept some, but it was $37 a share before the split. So in these numbers, this price would be $1,821. So their stock price was, when it got to 1,800 or whatever, got up to 1,000. They did a 10-for-1 split, and they said for every share that you had at 1,800, we're going to give you 10 shares at 182. So it just makes it less awkward. Having a stock price that's in the thousands makes it difficult. People typically want to buy, a whole share or whatever. You can buy fractional shares. That's not even a problem anymore. But just the same, for a marketing perspective, it makes more sense to have, a share value that's lower. And so you can see how much it's up. And you can look, we're looking at a period, so that's over 1 day. It's up $1.88 in price, which represents 1.04%. Here's some overnight trading where it's going. So, it's just so much more useful. And then that little bit of tab data we had, now we got the open, the bid, the ask. So there's a spread between the two that the market makers will set up. Anyway, days range, 52-week range, average volume. So now okay, this is a little below average. Number is typically 173, and now it's at 110. How big the company is, the market capitalization. Beta is very cool. So what you have when you have a stock that's going up and down, say, the stock is very volatile. Well, is it? What do we have in reference to? It's like saying looking at a boat on the ocean and seeing it go up and down, and it seems like, wow, that boat goes up and down a fair amount, but how much of that is just due to the tide? I mean, when you're looking at a moving target like that, when you say NVIDIA as a stock is very volatile, well, compared to what? And so for the term beta, what they've determined as that as the benchmark, the measuring stick, is the Standard & Poor's 500. So the Standard & Poor's 500 is a collection of stocks. And those stocks will go up and down. You could chart that price just like you'd chart NVIDIA. Well, when you look at the volatility of NVIDIA compared to the Standard & Poor's 500, you can come up with a number. So by definition, since the Standard & Poor's 500 is the measuring stick, the beta of the Standard & Poor's 500 is 1. It is the number. It is the measuring stick. And so when this thing says beta of 2.12, that means that the stock is twice, 2.12 times, as volatile as the S&P 500. So kind of useful to know. Price to earnings ratio can be important, the price of the stock compared to the earnings. But, certain companies like Amazon, before they, were widely adopted, their price to earning wasn't good. I mean, it was earnings per share. They weren't making any money. So these numbers, you can't just look at it in a vacuum. You have to be a little smarter. And but you don't have to be an expert. You can just kind of go with momentum and go, oh, this thing's a good company. It's doing solid work. Some analyst looks at all these numbers and he's happy and he gives me the thumbs up, he or she, whatever. You can get advice on these, but they're going to look at these numbers and they're going to compare them within the sector. And so don't think you're anyway. If I spent all day on this, I still would not be as good as a stock analyst who's been doing it for 20 years. So I want to know enough to make an informed decision, but I'm not going to pretend. I'm not going to think I'm the smartest guy in the room, because that's not where I spend every day of my waking hours. Some of these guys do, and so you can get recommendations. And anyway, we'll talk more about that. Getting unbiased recommendations for free, that's pretty much not going to happen, because they're usually there's so much people with bad motives out there that will act like they're giving you unbiased information, but typically not. Okay, enough of that. So selecting a broker or analyst. So yeah, the analyst recommendations. Now, you don't necessarily need to select a broker. You can just kind of get a brokerage firm. You don't need a personal relationship with somebody. But you do need to have, if you're going to be choosing individual stocks, you need to have some sort of, criteria, some sort of recommendations that you're looking for. And, if you go on something like YouTube or Twitter or whatever, you're probably going to get people that are shilling the stock, that are being very, very optimistic about their particular stock. If I own, let's say, back to NVIDIA, if I have got a position in NVIDIA and I'm in at, a lower price, I want that price to go up. How do I get that price to go up? By getting more people to buy it, supply and demand. So if I already got that stock, if I got a position, I'm going to try and pump that stock and tell everybody it's the best so that it will go higher. So there's a lot of different things on this, but you see this, this is, in crypto, it's like steroids, where they always are pumping things that may or may not work out. You need to keep things simple and find people you can trust. Disclose ownership. Yep, they certainly should. They do get in trouble from time to time when they don't. But anyway, and individual broker skills. The broker term here is kind of a misnomer, because what you're really looking for, again, is the analyst. This buy-sell function, that's largely been automated on the internet. That's easily handled. That's like buying a airplane ticket. You don't necessarily need to talk to the travel agent. But in terms of where do you want to go, that's a lot. That takes, some knowledge. And sure enough, just like stocks, you go on the internet and somebody says, "Oh, this place is the best." Well, then you find out it's the tourism board of whatever country, and they neglect to tell you some things that are not so nice about the place. So, anyway, brokerage commissions. So back in the day, these full service brokerages, not only would they maybe not give you the best advice, but they typically rip you off doing it. Now, they started with discount brokerages years ago, just because the efficiency of the internet made it so much easier. But now, most trades are actually free, and that's just what the market warrants in the competition. Now, there are problems. Certain companies have been guilty of what basically happens here is the reason, again, if you're getting something for free, it's usually because you're the product. Well, in this case, your product is, let's say you put out your intention to buy, a particular stock. I hate to keep bringing up NVIDIA, but it's just a simple example. Let's say you're going to buy, a big chunk of NVIDIA. And typically, if you're buying a huge amount of that stock, it is going to change the price of the stock ever so slightly, supply and demand. So when you place that order, it's placed by a broker or the automated system, and your order is submitted. Well, smart people have figured out that they can do a thing called front running the trade, which means, and again, this is done at fractions of a second and in large volumes of trade and large volumes of money, but it does make them money. What they'll do is they will submit a trade just prior to your trade by these, time increments that are smaller than we can perceive, but it does make a difference in the trade. And anyway, so they will sell your trade information to a third party who wants that information because they may choose to front run that trade and take advantage of that trading price that's going to be affected by these orders coming in. I know it sounds crazy, but whatever. That is Robinhood in particular, and some of the other brokerages that do everything for free. They have certainly been accused of front running the trades. They deny it, but these brokerages go to incredible lengths to make their speed of communication so quick to try to minimize those things, but it still happens, and it's with these small amounts of money, but when there's millions of transactions, it does add up. Okay, placing an order. So what do you need to know? You need the easy part. I mean, the hard part was doing the research, but when you actually go to place the order, the mechanics of it, dead easy. I mean, it used to be where you needed to know the ticker, the ticker symbol. So like Ford, for example, been around forever, so their stock ticker is F. Very easy. NVIDIA, yeah, they'll usually do something like that, NVDA. Different stocks will have different ticker symbols. But again, a lot of stuff predates the internet. The computer is perfectly capable of realizing when you type in, Microsoft, it'll go, oh, I think he wants to trade MSFT, Microsoft. So ticker symbol's not such an important thing, but you do need to make sure you're buying the right company. I bought a stupid. I was trying to buy Zillow, the real estate company. I was listening to a podcast or a radio thing, and I thought, man, that sounds like, something this was when I was actually doing more real estate stuff, and I said, man, if this could be automated, these guys could be big. So I went in there and I bought Zillow, but I actually hit the T, and I ended up buying Twillo. And it had great recommendations. This company's going to do great things. And guess what? You know, better lucky than good. Twillo was a great company. I mean, yeah, Twillo was a great company. Zillow not so much. And by dumb luck, I mean I made quite a bit of money on that trade. I didn't buy a bunch. I mean, I bought like $3,000 worth or something. But man, it went up many times. So it was funny. People still give me grief about that because, well, go figure, we did it in the office. Um, Buy or sell. So specifically, what do you want to do? Are you selling some stock you already have? Are you buying some others? How many shares? Now, this business with a round lot and odd lots, and the internet again doesn't care. You know, when you had some guy, you know, making these open outcries to sell your stock, it was a big deal, and they'd charge you more if you did an odd lot. But now, no. If you say I want to buy $1,000 of Microsoft, the computer can figure out how many shares that is, and because it's talking to another computer and there's not even going to be a human hand on this order, it trades for the same price. So very easy to do. Here is that NVIDIA stock. So you can see this is just from, I guess it was the last term. Yeah, March 21st. So it went from, what is it, 187 or so now, and it went from 117. So, I mean, this company is still ripping. And but again, the wisdom to know, man, maybe I should get out, maybe I should stay in. That's where you need to spend your time. And that has to do with the forward view. Stocks are priced not on what has happened. They're really supposed to be priced on, you know, forward expectations. Now, in reality, it's actually a combination of those, but you know, the true definition is it's a forward-looking price prediction or value prediction, I guess. So let's say we want to buy this NVIDIA. So you can see this one is even lower. So it was 955. So this was back before the split. So this would have equated to $95 on today's money. But before the split, it was getting up in the $1,000 range, and we were doing a trade. I don't have a date on here, but this was all within this year. So you decide what you want to do. You know, you got the symbol. You confirm, yeah, that's the right company. It tells you a little bit of information, what's going on with it. This is the buy, the ask, the spread. So that those two numbers in there. If you're you know, selling or buying, there's actually a different price, and that's how the market makers make their money. The volume. Here you go into the buy or sell question, so you can tick that and go either way. The quantity. Now you can put in the quantity. If you just leave it like this, it's going to go with shares. So you put in one, you're buying $955 worth. Now if you want to buy a dollar figure or something like that, this is on a Fidelity site, which is what I'm used to. But anyway, you go over here. They all kind of work the same, but a little calculator. You type in $1,000 and it goes 1.0 something shares. Order type. This is what I've portrayed over here. And then time in force is the day. It'll either be day, which means it gets executed or not executed today, or GTC, which means good till canceled. But this order type, this is critical. So I'm told that I want to sell. I put in a quantity, and then if I want to sell, like right now, the market's moving, I want to act. I don't want to screw around. I put it at market. That means that it's going to sell probably pretty close to this price because there's a lot of volume going on. So I'll probably get, you know, right in those numbers. If I say, I think it's dropping today, you know, I got some things to do. I'm not going to sit here and watch it. What I'm going to do is I'm going to say, go ahead and, well, here I'm selling. So I'll say sell at whatever, $975. So if it ratchets up to $975, boom, my limit order becomes a market order and gets executed at that point. Now, is it going to execute right at $975? No, it's going to convert to a market order, but because of the volume, it's going to get executed pretty close to $975. Then you can do conditional orders that are based on other factors, a little more involved. I don't want to get into. Yeah, they don't even go into an explanation of that. But stop loss, stop limit, trailing stops with percentage. So these are all available to you as a retail investor. This used to be stuff that you sort of dreamed about. This is what the big brokers had access to. So let's look at this example. Let's say we've got a stop loss, and you say, okay, I'm going to sell if the price gets to a certain point. So triggers a market order when the price you've set is reached or can be used to help manage potential gains. So let's say, I want to do something more involved here. I want to maybe let this let's say, we're selling it. It's going up in price. You've seen it go from maybe 900. Now it's at 955. You're saying it's going up to 1,000. But I bought this stuff for much cheaper. And if the market turns on me, I still want to make some money. I don't want it to rocket down to 800 and me lose all my profits. But I am kind of greedy, and I do think it's going up, so I expect it to go up. But if I'm wrong, I don't want to lose it all. So I'll say, you know what? I'm going to put in a stop loss. I'm going to say if it continues to go up, I'm not selling. But if it drops to, say, $925, I want out. Triggers a market order when the price you've set is reached. It can be used to help manage. So that's what's going to happen here. If it goes up to 1,000, sweet. If it goes up to 1,025, even better. But if it rockets all the way back down to wherever it was, 925, where I had that stop loss, I'm out. It sells everything and I'm done. Now, stop limit, this is just a limit order. It can be used to help manage potential gains or losses. So, again, just slightly different. But what you can do on these is you can have these trailing stops, which is maybe even a better idea. You can do it either in a percent or a dollar figure. And what you can do here is, okay, I'm hoping the stock price goes up, but I don't want to sit here and watch it all day. So I'm going to put in a trailing stop, and I'm going to say, whatever, put it maybe $25, $50 below this price. And what's going to happen here is if the price goes up, that's a good thing. Let's say you put in this trailing stop, and the trailing stop is behind it by, what did we do before? About $30 down to $9.25. So if you put in a trailing stop, set below it for $30, if it drops down to $9.25, it will sell. But if the stock price goes up to 1,000, your trailing stop trails along behind it. And because it's incremented $30 behind it, you now have a new trailing stop established at $970. You see what I mean? So it ratchets up. It follows it up, which is very, very cool, very powerful. Now, in reality, I probably got this stop set a little too close because there may be some volatility. We know the beta of NVIDIA was 2.2, so twice as volatile as the as Standard & Poor's. So maybe I should have gone with a $50 trailing stop. Whatever, that's some judgment in there. But if this price keeps going up and gets up to $1,500, $1,800, my trailing stop is going to follow right along behind it, and it's going to lock in those profits. And then if the price ever drops, I'm stopped out at that new price. So if the price gets up to $1,500 and then all of a sudden drops by $30, gets down to $1,470, boom, I'm stopped out at $1,470, which I'm kind of happy. If you're going to sell it anyway, if you're just going to sell it directly at market, if you have the expectation that no, it's still going up, but I'm a little nervous, maybe a trailing stop is a good idea. Anyway, we get more into that. But, some of these things, if you get invested with small amounts, you can make some sort of silly mistakes and learn some things before you start putting huge sums of money. But real powerful tools that are available to pretty much any account. So we talked about this. So market order, market order, sell at the prevailing price. Limit order, buy or sell only if the price hits the limit. And then the stop order, execute a transaction when the price reaches the specified level. Special form of limit order. Okay. And then, might be a buy stop or a sell stop. Placing an order online, low commission. So, no commission typically. Buying a stock on margin. This is where you get in trouble. This is buying stocks on margin, buying crypto on margin. Very dangerous. This is called using leverage. And what you're doing here is say you want to buy $1,000 worth of NVIDIA stock. You just put up $500 and you essentially take a loan for the other portion of it. Well, if you do that and you use that full 50%, you've got no room to go. If the stock price happens to fall, you have to put up some more money because your collateral is that money you have behind it, and the money that you're using as collateral is denominated in the stock. So you owe these guys, in this case you owe these guys $500, but let's say the stock has dropped by 10%. Well, now you're 10% of 500 short. You need to put in some extra cash to get back up to $500 in terms of the stock price. Anyway, I don't know if I'm losing you here, but the problem is you will get what they call a margin call. You get a call from the broker, maybe you just get a message, or maybe you just get stopped out, which means when the price drops, they just sell your stock. Now in crypto, people can lose millions. I mean, you can conceivably lose millions in the stock market, but the problem in crypto, some of these knuckleheads, this was just like last week or so, they were using what they call 20x leverage, which means they only put up 5%. They put up like $5 to buy $100 worth of crypto. So any fluctuations at all, and they get wiped out. And they did. So some of these guys who end up with these huge amounts of money, keep in mind that those are probably the only people you'll ever hear about. The people who lose everything, they just tend to crawl off and, lick their wounds. They're not making TikTok or YouTube videos about how they're an idiot. So keep that in mind, that the people you're going to see online are usually that small percentage that pulled it off. And the guys who got wrecked, you'll never hear a word out of them. Selling a stock short. Okay, so this is kind of cool, but again, kind of beyond, well, definitely beyond what you want to do as a beginner, and I don't even do it at all because the downside to it is very dangerous. Now, what you can do, and if you are inclined to, and the reason we talk about it is because you might have, hedge funds do it, and also some mutual funds also use shorting strategies. But essentially what they do here is they are expecting a stock to go down. And so what they want to do, and again, there's the movie The Big Short. There's also Dumb Money and a couple other movies that explain this a little bit more than, a little bit more in depth, and they give some examples. But essentially, I did this with Tesla stock back, this was very, very many years ago. And I actually made just a tad of money, but it kind of scared me to death because the downside risk is infinite. You can lose a lot of money by employing this improperly. But the concept of selling a stock short is you've got this stock, and I can't even recall the numbers, but let's say Tesla was trading for $50, and you're expecting Tesla to go down in price. You know, you're hoping it goes down to like $40. So what you do is you essentially borrow some stock from somebody else. Okay, so that somebody else is somebody out there in the market who's offering this as a short position. So you pay a fee to essentially rent their stock. And this will never work in the real world, like in terms of a car or something. If somebody loans you a car, you don't sell their car. But in shorting stock, yes, you sell their stock. So they loan you a certain amount of shares of the stock. You know that the market rate is $50 a share. You're expecting it to go down, and at the end of the rental period, at the end of the shorting process, you have to return the share. So let's say you take 10 shares, and you're essentially borrowing them, and the value of them at 10 shares at $50 a piece is $500. But when you return them, if the price has dropped, when you have to replace these shares, you're going to go out in the market and buy new shares to replace the ones you sold. And if the share price has dropped like you wanted it to $40 a share, you can buy those 10 shares for $400. And so, bada bang, you made $10 per share. Now, if you do this on a larger scale, you can see where this, really can go nuts. And when certain companies, GameStop or Open Door, I guess is the current one, but there's some shorting opportunities where they have a company that they think is going to fail, and if it goes to bankruptcy, I mean, your profits are, you can buy that stock for nothing and basically replace that stock that you borrowed. So you can make a lot of money. Conversely, if the price goes up, you guessed wrong, you're on the hook. You got to replace that stock. If that stock goes from, $50 to $500, hey, tough luck. You got to buy those 10 shares at $500 a piece to replace the ones that you sold. You're the irresponsible person who borrowed this guy's stuff, and they want their stuff back, and you gotta replace them, and you gotta replace them at whatever the market is selling that stock for. So that's where things can get weird. Now these employed by a smart person, and this isn't like a salesman person. This is somebody who's truly gifted in financials. When they say they're shorting a stock, now you go, oh, okay, I know a little bit about that. I know it can be super dangerous, but that's why I'm happy you know what you're doing. To do this on your own, pretty scary. So I've done it, like I said, the one time with Tesla. It actually worked out. Now, if you really want to do things like this, you can also look at options. And options are cool because options are the right but not the responsibility. So you pay a fee, you can participate, but if it all goes to nothing, you're only out the amount of money you invested. So anyway, we'll talk more about options later. But options might be a better puts and calls and all that kind of stuff. Very complex. It's its own terminology, but can be quite interesting. Technical analysis versus fundamental analysis. Okay, so when you're analyzing stocks, when somebody's doing this, whether it's you or a professional, and not to say you couldn't get professional skills, but there's different techniques, and usually it's a blend of the two. But people who look at charts and they talk about, oh, it's a head and shoulders, thing. It's there's Bollinger Bands, and there's this and there's that, and they're using all this technical jargon that explains chart movements and how things are going to go. That's technical analysis. They use a lot of charts. The thing with this, though, they're often automated. So by the time you perceive it as a simple human, um, some other human who wrote the algorithm and is now programmed a computer or some AI process to observe it. They've probably seen it before you did, and they've probably acted on it, and you're a little late to the party. So technical analysis is still relevant out there, but I've never been one for it. Fundamental analysis, that's a lot more, it's easier to understand, it's a lot more logical, you know. The valuations of stocks based upon examination of fundamental characteristics. So you're looking at the overall health of the company. You're going, yeah, this seems to be a good company. You know, when I said I bought some Lululemon stock, that was because I looked at the thing. I said, wow, this is, you know, there's a lot of adoption. You can see very popular, good products. I think these guys are going to make some money. And that's fundamental analysis. You can only take that to a certain level. You know, there's plenty of companies like that that maybe have some other factor or poor management or external whatever, bad market conditions, cash flow, all sorts of ways companies can get into problems. But, you know, that's where when I'm buying stock, I never buy it just based upon a hunch or anything like that. And certainly not off of, you know, some friend's recommendation. But if something seems fundamentally sound, I'll then look for confirmation, and not, you know, confirmation bias, but actually look at an analyst rating to see what they think. And even like Fidelity or any of these brokerages, when you look in there, you can generally find a impartial recommendation, and they'll have a buy as a sell. And then if you want to get more advanced, you find somebody who's got a track record and usually has a subscription type service, because again, you want these people to be providing, you know, fiduciary guidance. You want them to not be making their money from the commissions of you buying and selling stuff. You want them to be making their money, basically selling their advice. And some of them are that talented where they can do that, and it may be worth your time to do it. So anyway, fundamental analysis, technical analysis, different ways to select investments. So analyzing the firm's financial conditions, again, like I said, you have to compare them apples to apples. You know, how does NVIDIA compare to AMD, you know, Advanced Micro Devices? They're in the same sector. That might be a valuable comparison. Comparing, you know, NVIDIA to Ford is probably meaningless. And then income statements. So there's a lot of the financial documents that are out there. They're published. But again, you're probably not going to do this solo. You're probably looking to read an analysis from somebody else and go, okay, I see what they're talking about, that they're concerned about this portion of the balance sheet or the price to earnings ratio or some other position. So it's not so much that you're going to know it yourself, but you're at least going to be able to have an informed conversation or an understanding of what's going on, because you might find yourself actually being involved in this stuff, but for most of us, we'll have another job that's not related to this, and we're dabbling in retail investments. All right, impact of the firm's performance. So sales, yep, investors, it's all supply and demand. Supply and demand drives the stock price. If they're not doing well, you know, it's the lack of demand will drive it in the gutter. And then there's the overall condition of the economy, which is also a factor. Accounting fraud, yeah, but people do go to jail. You know, there are a number of people who cheat and they commit SEC violations, and they are punished. So that's good. But there is some political pressure involved, and it gets, yeah. Economic growth, the role of the government and, you know, the Fed, the Federal Reserve Bank, and all that other stuff, it's probably a little more than it should be, but it is definitely a factor. gross domestic product, so the total volume, fiscal policy, so what's the tax structure like, and then what else is going on. International economies. Yeah, the U.S. is still pretty dominant in driving these things. If you were in, Brazil or India or something, you'd be very concerned about what's going on in the United States. For the United States, we're still pretty dominant. We are affected by other countries, but not to the same level that they're affected by us. Interest rates, very political, manipulated. They should be manipulated by the market, but they're really manipulated by the Federal Reserve, and they're trying to set rates. The notion is that if inflation is high, they need to slow it down. They'll want to raise interest rates to sort of throttle back the economy. If inflation's low, they don't want things going into a recession, which is the opposite of inflation, where prices start to go down. So they don't want that. So they'll try and stimulate the economy by bringing the rates lower. So some stocks, tech sector especially, they use a lot of borrowed money, so very sensitive interest rates. The Federal Reserve, super controversial kind of thing, pseudo governmental agency. The government does, appoint people to it, but it's actually owned and run by the big banks. And the monetary policy is kind of the big picture. So, obviously, the printing of money and all the rest of that. The problem we have now is the government's about $38 trillion in debt, and when they're paying that kind of interest, they are very concerned about the interest rates. The high interest rates not only affect you and companies, but they also affect the amount of money the government needs to pay back. So they want interest rates to be low because they want the economy to be strong, but they also want to have to lower the interest payments that they got to pay on the debt. Inflation, we know what inflation is. Some of these things are, based on the survey data. So there's an inflation report, comes out on Friday, comes out on a periodic basis. And a lot of it's based on surveys, so it's pretty archaic. With the government shutdown, some of the numbers aren't necessarily coming in. There are competitors that have sprung up, Trueflation, a private company that will sell you the data. But when they're relying on phone surveys or email surveys, these guys, if you're, you can go to Fred Meyers, you can figure out what their pricing is. It's all done electronically. You don't have to send some shopper into the store to necessarily figure this out. If you've got the right data feeds, you can know, what the price of ketchup or mayonnaise or whatever is in Fred Meyer without sending somebody in there. And especially if you're trying to get somebody on the phone to answer a survey, that's just meaningless. And then they'll also change around the different items. Sometimes you're going, well, prices seem to be really going up. Well, but fuel prices were down, and fuel prices were a significant part of the survey, or something like that. Some things can have outsized effects. So, not exact science, but there's a lot riding on it. Industry conditions, yep. So anyway, I kind of find this stuff interesting. Like I said, I'm not a huge sports guy, so I spend some time studying these kinds of numbers. I can't tell you, I've got nephews and stuff who know exactly, batting averages and things like that. I do not. Nvidia price, I know it back a few years. So, if you don't have that sort of interest, though, I'm not saying blow this stuff off, because if you're going to invest in mutual funds and other investment vehicles and do it wisely, you kind of have to have a baseline of knowledge of this stuff. So even though you're not going to use it all the time, you're not going to have, when somebody's giving you advice, they're going to could be gaslighting you, could be giving you the ground truth. You're not going to know unless you know a little bit about the terms and how things work. Stock price, yep. Economics, low interest rates, low inflation. A weak economy, high interest rates, things tube. But right now, there's so much government involvement in the price. It's a fairly safe time to invest in the stock market because, rich people have control, they have votes, and when the market's going to fail, we'll just print more money and boost that right up. And so there's a lot of upside risk, and a lot of the downside risk is kind of subsidized. So hence the wealth disparity and some of the other things we got going on that are less than great. Limitations of stock knowledge. Yep. Trying to figure out the future is very difficult. Not all the factors are reflected in the stock price. So, yeah, that's true. Okay. So, I don't know. I tried not to get off on too many tangents. It's kind of hard to do. But I'll show you some movies that can kind of make this stuff a little bit more interesting and maybe even fun. Bonds. Yeah, bonds are... This isn't a great attention step. I hate bonds. I always have. Don't do it. Anyway, bonds, they don't represent an equity position. Bonds represent a loan, okay? And I've told you kind of how they work. Long-term debt securities, either by a government, since the government can't sell stock, they don't have that option, or a corporation may choose, hey, we don't want to dilute our ownership, we'll just issue a loan. Par value for a bond, in this example, we'll say $20,000, and that's the amount that you give them. $20,000 at the end of maturity, 10 to 30 years, let's say, so 20 years, they give you your 20 grand back. In between now and then, they give you some payments, interest payments, and then repay the par value. So you get all that interest over the years, and then you get your money back. Now, the problem with bonds, too, one of them is this call feature. Let's say they issue a bond at, I don't know, let's say the economy's rough. They're trying to stimulate things. Interest rates are high, and, they don't want to do it, but they issue a bond that's paying you 8%. Well, let's say a couple years into this 20-year bond, they can issue new bonds, and because of the interest rates have come down, they can issue bonds that they only have to pay 5% to. So they don't want to pay you any extra money. And if there's a call feature in the bond, they can say basically, the deal's off. Here's your 20 grand back, and we're not paying you 8% anymore. We're done. You can go buy a new bond, and that'll pay you 5%. And because there's a call feature, so it's not a good thing for you, but you knew the conditions when you bought it, and they had given you a little bit of an incentive saying, hey, it's an 8% bond, but keep in mind we can call it. So you were getting a slightly higher return, but we also told you in the fine print that there was a call feature, and guess what? We exercised it. Convertible bond, a bond that can be converted into stock, so maybe slightly more interesting. Anyway, the reason I don't like bonds is I've just never seen any opportunities where, we've had pretty good, favorable economic times, and I've had, it's not all on me, but I've subscribed and, spoken to some people who, not so much spoken, but done research to get pointed kind of the right direction. And so the returns I've got have smoked bonds. Bonds are more predictable and lower risk and all that. So for some of you, that might definitely appeal to you. What else? Bonds maturity. Yep. Bond sells at par value. So what they're talking about here is that, let's say the bond doesn't get called. Let's say you've got an 8% yield bond would probably get called. But let's say you've got a bond that you get today that's paying, say, 4%. Okay? And then let's say the economy gets a little worse. And so next year, the new version, the new 2026 model of this bond is paying 5% because they have to make it competitive. Well, all of a sudden your 4% bond doesn't look as attractive. So you can keep that bond and stick with your measly 4% and get that year after year and give up the fact that prevailing bonds are actually paying a bit higher, 5%. Or you can just say, I don't want this bond anymore. I just want to sell it. Well, you can sell it before maturity, but nobody's going to give you 20 grand for it because it's not as good as the bonds that are out there now that are paying 5%. So yeah, you can sell that bond on the secondary market, but we're only going to give you 18 grand for it or whatever the price is. We're going to give you a lower price because it's not as valuable. Now, conversely, if you've got, a high yielding bond and current interest rates are lower, well, all of a sudden your bond's more attractive and more people want to buy it. So there you go. Bond trading in a secondary market, that's just how you do it. You can keep it to maturity or you can sell it beforehand. So different ways to get rid of it. Same brokerages that you bought it from will probably be the ones to sell it for you. Treasury bonds, no risk really. I mean, full faith and credit of the U.S. government. So the interest is not going to be, keep up with inflation. Easily sold in the secondary market, but again, you think, oh man, I made 2 or 3% on my bond. I'm really happy, or 1%. And yeah, number one, it's could be taxable. Depends on what situation you're in with your taxes. Typically exempt for state and local taxes, but anyway, it's yeah, if you're going to park some money somewhere, might be one of the things, but it's more where I put money when it's waiting to be invested in a higher yielding investment. Municipal bonds, again, it's typically viewed as low risk. There have been some municipalities that have gone under, but interest exempt from federal income tax typically. Federal agency bonds, so these again could be maybe mortgage bonds, things like that, but the interest is taxable on this type. Anyway, different types of organizations, corporations will want to do these basically loans where they need the money and they're looking for you to be the lender. Corporate bonds, a little bit riskier because, companies, corporations can go out of business, so that's default. Default means, yeah, we're not paying anymore because we're broke. High yield sounds great until you see the other term, junk. So high yield and junk are the same, referring to the same thing, just depends whether, glass half full or glass half empty. So bond quotations, yeah, rates, maturity, yield, volume, closing price. So that same sort of tabular data, and they're not as dynamic as, they still chart them, but it's not something you're going to be checking by the moment. Okay, so we talked about how the interest rates change the value, tax implications. Yep, and so you're still going to be taxed in most cases unless they're tax exempt. Present value, the future payments. So this can be of use to you, if you want to look at whether it makes sense to do it. Risk from investing in bonds. Yep. So they may not be able to pay it back. Now the risk ratings, yeah, Moody's and Standard & Poor's, they will come up with these numbers, but or letters actually, and the grades are pretty inflated. So we'll look at some of the, I'll show you a sample here in a second. Yep. So companies can go out of business. So Is it much different? A company goes out of business and you had a bond with them and you had a stock position with them. And with the bond, technically you're in a better position since you're a creditor, but if the company's broke, the company's broke. They're not going to be paying anybody. So as a stock owner, yeah, you've got zero claim. As a bondholder, you have a claim, but a claim against a company that's non-existent. So not exactly powerful position to be in. So here's these numbers. So you can see BB, which doesn't sound awful. Well, yeah, it is kind of awful. It's down in the junk category. And you get down here in the bottom. These guys are probably going to be paying 18% or so to you. They're going to be paying huge amounts because they're probably not going to be around. So when you're looking at bonds, you're looking up in these multiple A categories and just the between Moody's and Standard & Poor's, whether they're going to use caps or lowercase. But we talked about the call. We talked about the interest rate risk, that you make this long-term investment and interest rates change. Sometimes people will marry these things up going, okay, I'm going to need that 20 grand back, but if they keep it for 10 years, that's when I want to buy my retirement home, so that'll be nice. I'll get these payments over the years, and then I'll get that chunk of cash back at the end. So you can select it like that. Yep. So you're making a forecast in terms of, anytime you buy a bond, you're making a forecast in terms of bond yields. Yeah, here's a matching thing we're looking at. College education. Okay, so that's just a little bit. I mean, I realize I spent a lot more time talking about stocks, but the things you can do with stocks, I mean, I barely scratched the surface on that. I hope I didn't create more confusion than I but I'm just trying to show you that there's so many things out there that are so useful. Term project, we can talk more about that at another date, but just keep that in mind. But I mean, people would have 20 years ago. I mean, this is what drove stockbrokers out, because when they're talking about sales and stuff like that, you can go in here and you can look and get changes. You can the time periods. It's just amazing amounts of information. Here's 1 day, all time. You can see how some of these are these candlesticks on the bottom. Sticks on the bottom are the volume. And you go back and 2008. What was it trading for? And you can figure that out, and then you can hold it and determine the price change between these 2 points. It's just freaking amazing. So much information can be derived so easily. And these guys, this is just a Yahoo thing. It's nothing fancy. You can also, now screeners, stocks, they should give you information on who's providing the research. But again, some of these companies, these companies that do this research, they will try to advertise, and so they will give a bit of information out there. Here it's Yahoo themselves trying to sell you on something. But if you've got a brokerage that's worth its whatever, if you have an account set up with them, there will be a fair amount of guidance and information that's given to you. I don't have an account with, say, Vanguard, but and I can't even spell Vanguard. But they'll have, information. They'll have Morningstar ratings. They'll have all kinds of information. Now, again, they'll want you to log in to get anything of any value, but the information is out there. But this really relies on you, on your internet skills, being able to sort out, the chaff from the actual good advice, the people are all hyped from the rest of it. but the information is out here. And um, again, if you're an account holder, or if you've got a proper login, if you're associated with a company and you've already got, say, a 401k or something associated with it, you've already got a relationship with some sort of brokerage, you can get in here and get a whole lot more information, and typically access to some free recommendations if that's part of your um, forte. Again, they're not going to give me a whole lot of information. Now, did you see on those quotes where they just said quotes were delayed 15 minutes? Again, if you're an active customer, you'll get quotes in real time. So even that sort of changes. But anyway, a lot of hype in there. Hope you got something out of this. We'll talk more about this stuff later. We'll talk more about mutual funds and some other avenues for investing and other opportunities. Till then.